Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and I showed you in a recent video Wall Street forecasts for returns over the next decade, and they were scary. Like retiring at 65 with nothing but Social Security kind of scary. Analysts at JP Morgan expect US stocks to return just 4.1% a year over the next 10 years, and they're the optimistic ones. Research Affiliates is estimating 2%, and Morningstar thinks we could be in for a decade of negative returns. And so now the natural reaction by most investors to this is just reach for more risk to grab a little bit higher returns, chase those hot stocks and turn in their portfolio into a casino. Now, all you out there in the nation know I love those high risk, high return penny stocks as much as the next guy, but there is a downside to all that risk. Just like riding the loop-de-loop after eating a funnel cake, sometimes it ends badly. So in this video, I'm going to show you how I double my return on safe investments to produce a return of 7% and higher on a risk that's about half the market average. I'll show you how this works, how to set it up, and then reveal 3 low-risk investments I use for higher returns. In fact, this is actually the same strategy used by billion-dollar funds like the PIMCO Credit and Mortgage Income Fund, ticker PCI, and mortgage REIT AG&C Investment to produce dividend yields of 8 and 9% on safe assets. Before we get started though, you know I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So let's take a look at that PIMCO fund to see how it can produce that high return on safe investments like bonds and mortgages, and then I'm going to show you how my strategy differs and how to set this up. Now I do have to warn you though, I'm going to be using bad words in this video. Bad words like margin and borrowing to invest. Words that cause a lot of investors to cross themselves and pray on their rosary. So yes, we will be talking about using margin to invest here, but I'm going to show you how I and these large institutional funds do it smartly to produce that higher return on even less risk than you get just investing normally in the stock market. So keep an open mind here. Watch through the video and listen to this strategy. And well, then if you want to, tell me I'm a moron in the comments. So if we look at the investments held by that PIMCO Income Fund, we see the majority is in very safe investments. Almost a quarter of the fund is in US government bonds and a third is in mortgages. But government bonds are paying less than 2% right now and mortgages aren't much higher. How does it get to that 9.8% dividend yield? And here we see the fund has about $3.1 billion in assets, but is investing $5.6 billion. So it's borrowing that additional $2.5 billion on those assets to invest and then increase the return. So for example, it might be getting something like 5% yield on the portfolio. So the investments themselves only pay 5%. But if it makes that on that $5.6 billion, then that $280 million dividend is like 9% return on the $3 billion asset base. And you know, I'm not usually a fan of these closed-end funds because of the fees. And for example, that PIMCO fund, you'd pay a 4.2% management fee each year for this strategy. Now I'm going to show you how to get this same low risk and high returns, but save on the fees. First though, while I do love this strategy for a portion of my portfolio, I also like to invest in those moonshot companies benefiting from the biggest trends over the next decade, the kinds of stocks that are going to 10x your money. If you want to know what those stocks are, I'm going to leave a link to the top 5 in my own portfolio. It's a totally free report. Just look for the link in the description below. Now the strategy we're talking about here though works on that balance between risk and return. A risky strategy like margin investing balanced by the safest investments in bonds and stocks. Most investing apps are going to let you invest more than your balance, what's called investing on margin. For example, if you have $500 in an account, the website might let you borrow investments worth $1,000. Now I'm going to show you an example of this next, but basically they're giving you a loan of $500 to invest. And what's going to be critical here is that you're investing on an app or a website that charges a low margin fee. Now you need to be earning a return higher than the percentage the site charges on that loan, so you're leveraging that excess return. The best investing apps for this strategy are going to be ones like Robinhood with its 2.5% rate for gold users, or M1 Finance with its 2% rate for any account size. You can get down to 3 or 4% on some of these other brokers, but you need a much larger account. And it's easy to see how this works. If you've got $5,000 in an account and invest $10,000 and the site charging you 2% on that borrowed $5,000, then let's say you're able to make even a modest return of 5% a year. You're making 5% on that full $10,000, which is $500 dividend, and paying the 2% on that 5% borrowed, or $100 a year. So if you take the profit, $400, and divide it by your actual capital, the $5,000 in your account, then you're actually making an 8% return on your money. But hold up here, before the dollar symbols start flashing in your eyes, there is a reason why I use that low 5% return in the example, and it's where most investors go wrong with investing on margin. And it's because most investors think, well, hell, if I can turn 5% return into 8%, why not invest in something riskier, like shares of Apple, which produced a 52% return over the last year? That would mean a profit of $5,100 in our example, doubling your money. The problem here is that those shares of Apple have also fallen 15% twice in that period, and margin investing can work against you just as well. That 15% drop in the shares would be a $1,500 loss on that $5,000, and you would still owe the interest on the loan. Now, if you would have held on to the shares, you would have come out winning, but a lot of investors are going to panic sell at the worst possible time. And so that's why I only use this strategy with ultra safe investments, funds of bonds and low volatility stocks that rarely fall more than 5 or 10% even in the worst market crashes. And we're not trying to get rich here, okay? We're just trying to earn a little higher returns so we're not stuck in that low return future that Wall Street says is coming. Now I'm going to show you the 3 investments that I use for this low risk, high return strategy and why I picked each. First is the safest here, the Vanguard Long-Term Bond Fund, ticker BLV, with its 2.9% dividend yield and 5.2% annual total return over the last 5 years. The fund invests in over 2,700 bonds, and you can see here nearly half of the portfolio is in U.S. government bonds, so risk-free, and the rest are all also in that investment-grade corporates with a very low default rate. The fund has a standard deviation of just 11%. That's the typical up or down swing in the price in any given year, and it's less than half the volatility that you see in the average stock. In fact, over the worst 5 days of last year's crash, the fund only lost 12% versus a 23% crash in the S&P 500. So this is going to be the safest on our list, and even with that 5.2% annual return becomes a 10% return with half the risk in stocks. We've still got 2 more of these safe investments to highlight, but I want to detail a little more on how to set up this strategy. When you borrow on margin from a broker, each stock or a fund is going to have what's called a margin maintenance requirement. Now, this is the percentage of the funds that you need to hold in your account to cover the money that you have invested. For example, the maintenance requirement for that BLV fund is 35%, which means you could invest $10,000 with just $3,500 in your account. Now that's $3,500 is 35% of the total $10,000 invested. But then why don't I do this? Why not invest full $10,000 on that $3,500 account? Maxing out like this would turn that 5% return into 10.5% return. You'd earn $500 on the total invested and only be paying $130 or that 2% on the $6,500 borrowed. So why not earn that higher return if you can? Because here, and this is important, if the investment does fall in value and you drop below that 35% requirement, you get what's known as a margin call. Now this is when you don't have enough in your account and the broker requires you to either deposit money or sell some shares. So here, and this is one of the golden rules of investing, you never want to be forced to sell an investment. If you sell, it's got to be from that analysis, not out of weakness. So instead, you want to borrow no more than the value of that part of your account. So in our example, borrowing $5,000 on a $5,000 account, and you might even go safer than that and borrow less. The strategy here is still going to work and you're still going to be increasing your returns. I also use the Spider High Yield Bond ETF, ticker JNK, with its 4.66% return and a 5.6% annual return over the last 5 years. And I hate the ticker here and playing off that term junk bonds, non-investment grade bonds, because it's actually a very safe investment. Half of the 1,200 bonds held in this fund are near investment grade, and the portfolio is spread out across every sector, so that risk is diversified. The fund's standard deviation is just 12.7%, which again is about half of the broader stock market, and that 5.6% annual return gives us a little more than the corporate bond fund. Next here is cutting a little close on the risk, the Invesco S&P 500 Low Volatility ETF, ticker SPLV, with its 1.6% yield and 10.5% annual return. The fund holds shares of 103 stocks from the S&P 500 index, the most stable companies among the largest in the US. You can see here some of these: Colgate, Pepsi, Johnson & Johnson. The fund is spread out across sectors with a little bit more weight in consumer staples and utilities, but that's just because that's where you find those safest companies. So even though this does invest in those stocks, which are going to be riskier than the bond funds, It's the safest, least volatile stocks in the market. In fact, the fund has a standard deviation of 15%, which is well below the 21% volatility on the entire S&P 500 index. So then taking these three funds with annual returns of 5.2, 5.6, and 10.2%, we get an average 7.1% annualized return on a very low-risk portfolio. If we were to invest that, like in our example, with a $10,000 investment, we would earn a $710 a year, with $305 that in dividends on a $5,000 account, or a 14.1% return after paying that margin fee. Now again though, understand this isn't my entire portfolio, and it doesn't mean that you can't invest in those riskier stocks for the higher returns. I use this safe part of my portfolio for that reliable return and the lower risk. Then I take the rest of my money and reach for those higher returns in the penny stocks, the tech stocks, and the growth. I always know I'm going to have a portion of my portfolio producing those strong yields, the strong returns, and another part that is shooting the moon. Click on the video to the right for the 5 stocks I'm holding forever. 5 stocks to buy to benefit from the biggest trends in the next decade and beyond. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.